All right. Hello, everybody. Welcome to the monthly VIP session. I think we're live. Yeah. What's going on? Happy Wednesday, September, all that fun stuff. You just see here. Just type in, let me know you guys can see and hear okay, and we'll get rolling. Hey, what's up, Joan? Ali. Hey, guys. Audio good. Okay, awesome. Sorry for being 3 minutes late. That was flipping in and out of two different Zoom accounts, but no excuse. Let's roll. Thanks for the let me switch out from yesterday, which was pure chaos, into today. First day back, and yeah, nice little sharp sell-off. So I'll give you some context about what we think's going on, get you updated, what we're doing between my two businesses, and see if we can prep for September, which seasonally historically is a bumpy month, and they got right after it yesterday. And yeah. Okay, so let's go in order. How are you guys doing? How are we feeling going into the final 4 months of the year? September, October, November, December. Yeah, one more month in Q3, then we roll into Q4. How are you guys doing? Skittish. Well said. Well said on skittish. Yep. I understand that. Okay. Yes, let's hit it. Okay. Let me just make sure we're good here. Present. I even put a little presentation together for you guys. Share screen. Number 4. Share. And I'm even working on this new, this feature has been out for years on Windows, but the desktop sharing, or the desktop, virtual desktops, multiple desktops. So I'm getting more and more comfortable doing that rather than having my windows all over the place. So that's kind of fun. Okay. There we go. All right. So as I said, I put a little presentation together for you guys. Get you caught up on what we're doing here. Let me just get comments, questions. Turn to meeting. Chat, no. Home. Chat. There we go. That's up. Just pin this. Show this on all desktops. Show this on all desktops. And okay. All right, there we go. Yeah. Okay. So, I think it's important that we look at the macro first. And, that's going to be, that's my approach to the markets. I'm for the most part, I'm a top-down guy. Now that we're through earnings season, we still have Broadcom coming up Thursday after Nvidia on the 28th. But I think we're going to go back to focusing on the macro as the Fed is set to move into its first rate cut in September. So the global macro is essentially following the 4 major asset classes that equities is one of, but the 3 other major asset classes, fixed income, commodities, and currencies, to varying degrees will impact the stock market. And more times than not, fixed income, which are your bonds and bond yields and yield curve, will have an impact on the stock market. Usually fixed income will lead where the stock market goes. FX is very much related, sometimes on a leading basis, sometimes on a lagging basis to fixed income. So where the dollar's going and where the other major currencies around the world are going, and that is very much reflective of where rates are going. Those two have a big impact, I think, on equities and commodities. Commodities, the big thing that's happening now is, I think, crude oil pushing 70 in the face of, huge geopolitical escalation in tensions, Middle East. You'd think crude would be higher, but it's not. So all of those three asset classes are having a big impact on where equities go. And it's specifically the equities appetite for either value-oriented stocks or growth-oriented stocks. And as a trader, certainly as an investor, hopefully you're both an investor and a trader. That's going to have an impact on stocks you trade and the way you position your portfolio. So again, now that we're through earnings season, which was really good, I think it was very good. We're going to go back to focusing on macro, which is the first rate cut coming in September. We have non-farm payroll at the end of the week. We have CPI next week, and then we're going into the first Fed rate cut, and we'll see what the appetite is, not for October, but for November in terms of another rate cut. Is 25 basis points, which is 0.25% or 0.50. Is that on the table? The Fed policy is going to impact, and what Powell says to us is going to impact those fixed income or interest rate and the currency market. Since you and I spoke last, I believe, on this monthly free VIP program that we're doing, we had the big yen carry unwind. And that's very much related to the expected, the move down in US 10-year yields and interest rates that drove this yen carry unwound and this big summer swoon that we saw in the first month of August. I've been through this. I've seen this movie before. I used to trade for a hedge fund, an FX hedge fund during 2007, 8, 9, and 10 during the global financial crisis. That was a real yen carry unwind. This was a little baby one. So, it's really interesting to see how those other asset classes will help you trade or invest or both the stock market. And listen, whatever way you look at the stock market, whatever way you set up your trades or your investments, it's subjective. Unless you're a systems-based trader where you put a system on and you let it run and it's fully quantifiable and you don't adjust it and you don't deploy different systems or tweak your system along the way, it's all subjective, right? So, I think the knowledge of what's going on in the markets that are beyond and bigger than the stock market will help you reduce some of the inherent subjectivity of whatever approach you use to figure out how to handle your trading account or your investing account. So, it's been post-COVID with the spike in rates and inflation. Macro has been such an important part of my day-to-day process as I'm running money for my wealth management business and trading accounts for my research business, tradinganalysis.com. Okay. So, I think we really need to know what's going on. And we have, on top of that, we certainly have seasonality, which is a form of technical analysis. We know historically September is a nasty month. I'll show you that September is the only month on average in the NASDAQ composite going back to 1970 that on average is negative. All the other months in the NASDAQ composite are positive. VIX is also elevated at this point at this time of the year as well. You throw on top of that, we're now in an election year that only compounds it. So, and I see the negative comments coming in here. Everyone's scared. Everyone knows the seasonality. Everyone's aware of this. And they really came in and hammered it in the first day post-Labor Day. Yesterday, Nvidia was down 8, 9, 10%. So did they pull that expected volatility and stock market weakness ahead? And are we starting to see a little bit of support coming to the market? And what do we have ahead for September? I think the first thing we should all say, we should all get together, hold hands, and take a deep breath and say, I don't know. We can't know what's going to happen. Anything can happen. And the longer I'm doing this game, which is now, I started professionally trading in 2001. It's 2024 now. The longer I do this, the more comfortable I'm saying, and more comfortable I am saying, not only to myself, but especially to tons of people, I don't know what's going to happen. And none of us know. It's not our job to foretell the future. Our job is to thoroughly assess the now and hear what the market's telling us today, put ourselves in the best positions to be in, such that, whatever your time frame is for trading, as long as you're going through your process now and you're doing the best job you can at assessing the now and realize what is coming down the pike, you don't have to stress about what the future brings. Just thoroughly assess the now. That's why I name my wealth management business Inside Edge Capital, because it's not trading on inside information. It's not anything like that. It's based on, I was a college ski racer, and we're going to completely redo the website. But the idea with ski racing is, this was me freshman year in college. The idea is, before you get into a course that you're doing 60, 70 miles an hour down over the course of the next 1 minute, there's a ton of prep that goes in, not only course inspection that day, coming up with a game plan with your teammates and your coach, but preparation for your body, preparation for your equipment, knowledge of the course, and coming up with a whole game plan. There's a lot of prep that goes into it ahead of time to thoroughly take care of all the variables that you can account for ahead of time, such that when you're in the course and you're ripping 60 miles an hour, a lot of what you're doing is based on part of your game plan. And your mind has to be free to account for variables that will inevitably pop up in the course of the race that you can't know ahead of time. So you have to have a game plan. You have to have everything that could be accounted for dialed into the game plan. And then when you're in the race, you got to expect the unknown things popping up, and then you fully account for that, and your mind is free because you're firing on a game plan. So like a trade is the exact same thing. So that's the real meaning of Inside Edge Capital, the wealth management business. The real quick elevator pitch is, in a 60-second course in a ski race, you want to set up high, cut the apex of the turnoff, have good tactics, accelerate out, avoid the bumps, and get to the finish line, your finish line, financial finish line, as quick as you can on the smoothest fashion. That's the quick elevator pitch. So, that's the way I'm approaching the trading markets for my research business, trading analysis. And that's the way we approach the money management business for Inside Edge Capital. Okay. And this is a big, big part of being a good trader and investor, is to understand what your risk tolerances are, what your financial plan is, what the account that you're trading represents. If you don't understand that, you don't have confidence to stay into a trade and maximize your profits. And also take the required risk in each trade or group of positions, the required risk that's you're going to have to put out there in order to see your trade plan through to completion, your investment goals to completion. It's all got to be part of the plan, especially if you're an active trader, an active portfolio manager. So I just wanted to, talk high level with you guys a little bit on that one, because, you got to understand what it is you're here to do, what this account that you're trading, or if an account you're considering trading, what it means to you. How does it fit in the overall plan? Only then will you have confidence. Is this everything is accounted for? The risk you're taking is accounted for. If you're comfortable with that risk that you're taking, only then can you see your plan through to completion and make a ton of money on a trade or a position or investment. If you're unsure about what that money represents to you, how it fits in the overall portfolio, you're screwed. And it took me a long time to understand that lesson, to get comfortable with the capital at risk. When I traded for the hedge fund, I was trading way too big. I was trading my boss's money, CEO's money, investors' money. I didn't know what I was doing on risk management. And I was so scared because I was a 27, 26-year-old kid, didn't know what I was doing. And I was afraid to see my trade plan through to completion. So only when I could conceptualize risk, only when I understood how to position size each trade, even though, and on top of that, like how much I'm risking per month. Once I got risk under control and I was comfortable with the money at risk, only then can you fully exploit and realize the upside in a trade or an investment. So I hope this is not falling on deaf ears. This is all I've ever done for 23 years. I started trading in 98 or 99 on E-Trade. This is all I've done now. I guess I'm coming up on 25 years. This is the truest thing I can tell you and the most valuable. I know you guys all want to get into chart setups and show me the L8 wave count and how to make money now. But, unfortunately, that's what I hate about this business, to be completely honest with you. I like to work with people who understand that it's a bigger holistic approach. And the only reason I go down these tangents is because I actually care. There's a lot of people who don't care and they just want to sell you setups and indicators, and they don't give a shit about what happens to your account or, what happens to you, because they just want to sell you, here's the next trade to get rich. I never want to do that. I refuse to do that. So I hope you hear what I'm saying, because it took me 2.5 decades to be able to formulate that little 10-minute speech. And maybe you already know it. If you're a good trader or investor, maybe you know exactly what I'm saying, or you have a different version of it, which is great. But you have to have that conversation with yourself, especially when the markets are bumpy and selling off and Nvidia is down $10 in a day. You're like, after it split, you're like, oh man, that really puts you to the test. And if you don't have the risk parameters and understanding how much you're risking, you don't have that set aside and on paper and part of the plan. I mean, you can freak out and sell Nvidia 104 pre-market, and here it is 108 and a half here now, up 4% after you sold the lows, right? Anyways. Okay, cool. All right, good stuff. Let's go. Screen share, return to meeting, screen share. And here we go. Let me just do a quick market check here. It's been about an hour or so since I checked the markets. Oh, and by the way, I really like this Bing, this little wallpaper install thing that they have. It's a new wallpaper every day. I kind of like it. They have some really fun pictures. So anyways, here's the market right now. Let's just see what's going on. So yeah, so Nasdaq's up 0.25%. S&P is flat. So, markets are down 7/8% and we've stabilized. I'm going to guess that Nvidia is probably 108.25 is my guess. Let's see if I'm close. 109.25. Nvidia's up. Look at that. All right, we'll come back to this. Everything's stable. So again, I'm going to get on this macro path quickly, if that's okay. Not quickly, but I'm going to get on this macro path, and then we'll get into the chart setups that I know you guys all want to do. Okay. So I kind of put some stuff together for you quickly. And I just, I did CNBC, I don't know, a couple of weeks ago about the yen carry trade. And I made the point, that they're saying this is the next yen carry unwind, just like we saw in 2008. Well, this was the sell-off in dollar against the yen. Okay, dollar against the yen. That means USD is selling off and JPY, Japanese yen, was strengthening relative to the dollar. So, yeah, it was a pretty sharp sell-off. The Nikkei was down 12% overnight, which was big. And they're saying this is the next GFC. And I'm like, hold your horses there, cowboy. This was the dollar yen sell-off in the global financial crisis. This is what we saw in August. Not even the same ballpark. Okay. So I'm not going to spend too much time on this, but it was just kind of funny how people were overreacting to this. It's a summer move. Okay. Let me just drive this point home, because kind of the same thing happened yesterday. So it's even better viewed in, let's say, euro yen. And you don't need to understand what exactly the carry trade means and all that. I'm just trying to drive the point home that they said that this sell off right here, this is the monthly of euro yen. The yen carry trade coming off was this, just like the GFC when we almost lost the financial system. This is the monthly candle of euro yen in July and August. This was the global financial crisis when I was trading for the hedge fund. Totally different ballgame. Aussie yen is even more extreme. Aussie is a Chinese proxy for commodity demand, how China's doing. This was the Aussie yen sell-off in the global financial crisis. This was the August sell-off. Different ballpark. CAD yen, Canadian dollar, same thing. Okay. So, it's summer is the point. And yesterday's sell-off, I had a huge down day, in the portfolios. We're still net long. But I'm like, you know what? It's the first week back after Labor Day. The jets didn't land yet in the Hamptons and the south of France and from Aspen and, out of London. People are trying to enjoy the last little bit of vacation. It's big institutional money. So they're going to be trickling back onto the desk here at the end of this week as we get into non-farm payroll, get into CPI next week, and then we get into the first Fed rate cut. So I almost read it a little bit yesterday like, the mice are away, the cat's away, the mice will play. Okay. So, I said it yesterday, and I'm not just saying because the market's rebounding today. I was like, I think this is a pretty excessive move after a pretty good Nvidia report and a collective Q2 earnings season, Q3 earnings season, excuse me. Okay. So macro, what's going on? Well, the 10 and 2, those are the two yields, interest rates that, we like to focus on. 10-year yield is a big determinant of all the prevailing interest rates in the U.S. economy with the mortgage, 30-year mortgage, credit card loans, building loans, mortgage. I said it, this is like, that's the main interest rate in the economy. Hey, Max, I'm just doing a live stream. Can I call you after? Awesome. Thanks, man. Bye. So 10-year yield is a big determinant. And then the 2-year, the shorter term, is going to be one of the closer proximities to where the Fed is expected to go with interest rates. Well, the difference between the 10 and 2 yield, so you take the 10-year, prevailing 10-year yield, subtract it from the 2-year yield, and that's going to be the so-called yield curve. And you can get it right on CNBC. Take the 10-year yield, subtract it from the 2-year yield. And as we got below this color-coded line, that's inversion. And typically that signals recession. Well, there's a lot of reasons that, like what happened the last two times the yield curve went inverted, 2000, 2008, that did bring in recession. It's different now. And there's precedent pre-1997 when we were in an inflationary time where it doesn't necessarily mean recession. Okay. And that's a longer conversation. But what's happened since July and August is we've been fighting out of inversion. And what's happening is the 2-year yield is dropping, reflecting coming rate cuts, where the 10-year yield is kind of holding its own. And the 10-year yield yesterday really didn't move on this massive sell-off. If we flip over and go to yields, here's the 10-year yield. Where do we go? Fixed income right there. TNX. So the 10-year yield yesterday, we moved down a little bit, but not much. It's really pretty range bound. This is the yield, 3.78. We're starting to head lower, but it really didn't move much. Okay. The 2-year yield, which there should be 2 overlaid with 10, the 2-year yield, let me make that a line chart. The 2-year yield in black, see how the black line's been making new lows as the 10-year yield has been kind of the blue line's been kind of holding its own. with the 2-year yield slightly moving lower and the 10-year yield going sideways, that is what's allowing the yield curve to move out of inversion. Because again, we're taking the 10-year yield, subtracting it from the 2-year yield. 10-year yield is staying bid. The 2-year yield is acting a little weak, and that's what's trying to push this guy out of inversion. Okay, and that's good. This is a live chart of it. And I get end of day closing prices on the 2-year yield, so I don't get intraday on it. But that highlighted line is the zero between inversion and a normalizing yield curve. Okay, so yesterday's big sell-off in the market, we didn't see bonds do anything. Yields didn't do anything. It was just a stock market sell-off. And what did accompany it lower was crude. And crude is trying to discount in a slowing economy. And it could be the case. However, I think it might also be political where, if the Democrats win the Oval Office, we'll see what happens with the House Senate. But, I don't think energy companies are going to do too much to invest in future exploration or production. Trump comes in, he says he's going to flood the economy with oil to drive down prices, which that's not going to help them either. So it could be that. It could be crude oil is pricing in economic slowdown. It could be, and hopefully the market's pricing in de-escalation of tensions in the Middle East. I don't know. So we have to kind of figure out how the news flow impacts this. But from a technical point of view, I'm still tracking a triangle on this guy. And while we're above the C wave low at 67.70 on crude oil, could be a triangle. And I'd like to be bullish on energy longer term based on this pattern. But if we start breaking 67.70, we're only $2 from it right now. That's a problem for this pattern. That's okay. And then we're going to have the A wave lows at 63.90 area. But these are going to be support levels. If we start breaking through this, there's something serious going on, either fossil fuels being phased out, economic slowdown, something political. We don't know, but we know where fundamentals meet technicals based on these lines that I showed you. Okay. Last thing, gold is not doing anything for the stock market. It's all trading based on rates. It's all based on rates, where real yields are going. And I could show you proof of that, but it's all based on where rates are going. Gold is not a hedge on stock market volatility. It's all rates and real rates. Okay, so longer discussion there. Tracking Bitcoin gold ratio, and I'm getting off script, but I just want to drive this macro point home. Bitcoin gold ratio, we failed at a triple top going back from 2021 to late 2021. We came again in 2024. 3-wave sell-off. I'm still okay with this. If Bitcoin can start to outpace the gains in gold, or Bitcoin can show relative performance to gold while we're above this 2021 region, then I think we may be able to push higher. Bitcoin can go again and outpace gold. Okay. So that's a lot of macro for you. Copper's also selling off. I think that's pricing economic slowdown. That's not an energy, it's not what I said, the micro influences on crude oil. Copper selling off. That's going to be a lot to do with slowdown, as well as China being under pressure. Okay. All right. That's a heavy macro dose for you, and I'm not quite done, but we'll get moving a little faster here for you. So that's 10-2 spread. So again, with yesterday's sell-off, fixed income didn't go anywhere. 10-2 curve is coming out of inversion. Earnings were good. Everyone knows we're coming into a seasonally weak period. We have the Fed about to cut rates. This is the difference between Fed fund futures in red, which are, 5 and these scales are off. These scales are right? 5 1/4, 5 1/2, where the 2-year yield is backing away. And the 2-year yield is right here, 3.99. This was captured a little while ago. This one is not exactly right. But the spread between Fed funds and 2-year, which are normally correlated, are about as high as they get. This is the spread between Fed funds and 2-year. So we have a resistance level about 1.5 150 basis points is the max over the last 25, 30 years that they'll get, which means Fed fund futures are likely to come down and catch down to where the 2-year yield is. The Fed's going to cut rates, and it's not cutting rates to stimulate growth. This is what's different. It's cutting rates to normalize higher borrowing costs that were combating price increases from supply chain constraints. Supply chains were choked off. We're not cutting rates to stimulate growth. Growth is fine. GDP just came out. The second reading of Q2 GDP was quite strong. So, I mean, we still have economic growth. Earnings are solid out of the S&P. GDP's there. It's not that. It's to normalize, I would say synthetically high rates that were required because of inflation. That was because of the lack of supply post-pandemic. So that's why we're cutting rates. We're not cutting rates to stimulate growth. Growth is fine. And the housing market's a little crazy. But we are coming into seasonality. So here's the S&P, the NASDAQ, and the VIX, the average monthly returns from varying periods. So 1950 to 2024 here. So 74 years in the S&P. September is clearly a negative month. It has one other on average negative month here in February, but you can see how deep this one is. And currently, I just captured this chart. This is where we are for the month. This is the average decline over the last 74 years for September. So we're already through it. But the good news is October, November, and December for the S&P are going to be the strongest 3 months. Same thing with the NASDAQ. NASDAQ, the only negative month is September. We normalize in October, and then the second best year is going to be November. First best is January for the NASDAQ. Now, the VIX is interesting. VIX, or volatility, which is traditionally inverse of the S&P, has some elevation in July, high move in August, and then the highest are August and September. Well, we're certainly seeing that. That's the current VIX reading right now. So we're certainly getting the seasonality coming through. But again, did we pull forward in the first week of August? Did we pull forward in the first week of September? We'll see. And then we back off in October, and then we're the weakest period of the year for the VIX is November, which low VIX usually equals higher stock market. Okay. So we're certainly coming into a volatile period, but again, everyone knows it. If you want to take a look at sector seasonality, I've got all the 11 sectors here. It should be 2, 4, 6, 8, 10, 11, 12. Oops. Why do I have 12? I must have one twice. Anyways, maybe not. It should be 11. Anyway, you can see September is, a bad month for utilities, not the worst. Financials, September is the worst month, just behind June. Energy is also, September is the worst month. Materials is the worst month. Technology by far is the worst month. Industrials, consumer discretionary, communications, real estate by far, which is interesting because real estate's been so strong. September is usually a terrible month for real estate, but with rates moving lower, we're getting real estate and utility showing a good bid. Check out Southern Company, SO, on the utility side. Things ripping. It's defensive, but it's also a power play for the AI build-up. Healthcare, bad month in September, as are staples. But the big ones are going to be comms, which this is not great because this is only 5 years of data because the comms sector is so new. But that's just a look at sector seasonality for you. So I want to look at rotation. So this is the relative rotation graph. And let me pull questions up. I know I'm just rambling on here. Everyone good? So this is monthly and weekly relative rotation graphs. So what we're doing is we're charting 4 ETFs against the S&P. And this is a static capture. I just captured it for you. Optim is really hard to use in real time, so I screen capture and throw them on there for you. But this is the monthly on the left. Each dot, each segment from dot to dot is 1 month of trading. This guy's the weekly, same thing from one dot to the next is 1 week of trading. And what we do is we watch these generally circle around the benchmark, which is the S&P 500 in this case, on a clockwise basis. And as you move in a clockwise basis, you're picking up relative strength and momentum. If you're over here, you're leading. Over here, you're still in a leading position, but you're starting to weaken. And then over here, you're lagging. And then here, you're improving. So what you'll see is the mega cap ETF and the large cap ETF are certainly to the right. And that means they've been massively outperforming the mid cap and the small cap ETF, but they're starting to hook back down here on the monthly. Okay. And the mid caps and small caps are starting to hook up on the monthly. Now, remember, this is 1 month to the next. So this is like 6 months of data. This is like 6 to 8 weeks of data on the weekly. So we're getting the mega cap selling off a bit, and we're getting the mid and small making a big move up and in, which means we are, again, picking up relative strength, which is on the horizontal axis, and relative momentum, which is on the vertical axis, to these guys. But we haven't flipped yet. We haven't got smalls and mids on the right side and mega caps on the left side. Okay. Now, these guys are going to be really small, the large caps, because they're so heavily influenced. They so heavily influence the S&P. There's a lot of large cap in the benchmark that I'm measuring, right? The S&P 500, right? So it's going to show very small moves, but the heading and the direction are what's important, right? And there's very little influence on mid and small caps on the S&P 500. So they're going to show a big move when they do make a move. Okay. So smalls and mids are coming in. There's good setups in sectors out there that I'll show you that are not mega cap, large cap growth. And we're seeing a big rotation in various sectors into the market that are not just tech. It's not just a defensive rotation, but it's a cyclical, meaning they're discounting an upswing in the economy, quite contrary to the call that we're going into recession. So as we break that down a little bit between small, mid, and large cap stocks, let's go small, mid, and large cap growth and value. Okay, monthly on the left, weekly on the right. So what's happening? The direction of the arrows is important. The Vanguard growth ETF is dropping. This is heavily large cap focused, and this is the monthly. This is the weekly growth, both heading down. So Vanguard growth, they are in a downward heading. They are rotating out. They're still to the right of this, which says there is still relative strength to the other guys I'm talking about over here, as well as the S&P 500, which is the basis of this chart that we're looking at. They're still to the right, but the heading is saying there is an attempted rotation out. If growth goes to the left and all these guys wind up on the right, okay, then we have a full rotation. They're trying to rotate it. And who's they? Well, here's the value. This blue guy is the counterpart to growth. Value stocks like financials, industrials, materials, real estate, utilities, staples, everything pretty much not tech, not communications, and most of consumer discretionary is going to be value. But that's a simplification. So value is coming in as growth is coming out. Mid-cap value is also tracking where value is going. Small cap value is tracking where these guys are going. Behind that, still rotating in, small cap growth and mid cap growth, right? So to a lesser extent, the small and mid cap growth guys are gaining relative strength and momentum along with all of the value guys across the different capital structure as growth is rotating. The large cap growth is rotating out. It doesn't mean that all of these guys we're tracking are going to continue and make a full rotation in as growth rotates out. They're trying, but there's no guarantee that they're going to get up over the hump here and move into leading. And just keep in mind on the monthly, there's a lot of space between growth and large cap growth and everything else. This space right here is a lot of percent return over the last couple years. Tons of percent return that is much better in the growth on the mega cap growth and large cap growth than all the other guys over here. Yeah, in these hooks, which happened 1, 2, 3, 4, 5, 6 weeks ago, I'm counting the segments. Yeah, there's been good outperformance over the last 6 weeks on small and mid cap growth small, mid cap, and large cap value compared to large cap growth over the last 6 weeks. But there's been 3 years of significant outperformance on the growth side. Could that change? Yeah. Has it changed yet? No. So just keep that in mind. And this is why the rotations that we track at Trading Analysis is so important. If these guys were to fail at the center line, it's a failed rotation. And I think growth then does this, and you're going right back into the large caps. And that's when you pick up your growth stocks against your technical support levels. Another way to look at value growth, monthly, weekly. Here's the value growth ratio in blue, meaning value. If this blue line's going down, value is underperforming growth. Growth is outperforming value. We did a triple bottom here in value growth. We're trying to decide where to go on this value growth ratio. If we break the triple bottom, that means growth is outperforming value. That means growth rotates back up, doesn't make the switch over into the left half as value goes into the right half. That means you go right back to work in value, in growth stocks. If we do the flip, growth goes left, value goes right, okay, then this guy's going to hold and value is going to continue to outperform for some time, maybe enough to get the monthlies over, which, that'll take another year to get over growth to switch places with value on this monthly rotation chart. Okay, and then look, this is 10-year yields. Clearly, the drop in yields has been powering the growth stocks ahead of value stocks because value growth ratio is dropping. Rates moved up, value growth tried to rally in 2022, sold back off, even though rates are elevated. If this guy breaks down, growth outperforms value, maybe it's a case of the stock market being a leading indicator to bond yields, fixed income, that U.S. yields need to come back down. And they're artificially high post 2020 inflation rage, inflation spike caused by supply. Yeah, there was a lot of fiscal and monetary stimulus out there, but it was a lot of supply that drove those costs up. So this is the rotation of the sectors. Okay, so tech, comms, financials, consumer discretionary, industrials, materials, healthcare, staples, energy, utilities, and real estate. This is monthly. This is weekly. What do we see? Tech and comms are still to the right. And all of this space between these two is outperformance over the last multiple years, right? We have a few of the guys trying to hook up out of the basement down here. Real estate, utilities, staples. Those are, a lot of your defensive plays trying to move up. Healthcare is in there. Materials are in there. The guys that have really made the move, financials are doing well. Industrials are trying to hook up here in the monthly. Fine. Tech and comms are dropping. And this is going to be the more hyper weekly, right? And what's happened? Real estate has been ripping. Real estate has been ripping on the weekly, but we got to keep in mind, it's still the weakest chart on the monthly. Okay, real estate's done well ahead of a rate cut. Utilities have done well ahead of a rate cut. Plus, I think there's some growth influence on that because there's so much power demand in the AI build out. And to run AI, I think there's certainly going to be part of that. Take a look at Southern Company. I have the position on in the wealth management. I have it on in the research business. This is a utility that's acting like a growth stock. Broke out. I mean, that's insane, right? So here's Southern Company to the S&P. Okay. So real estate, utilities, financials doing well, staples doing well, healthcare doing well, industrials doing well, some industrials, building, defense, there's some areas that are doing well. Consumer discretionary is a big mixed bag. There's some that are doing not so well, but some areas like durable goods, home builders, there's a lot of stuff there. Even some retailers are doing extremely well in XLY. Kind of a mixed bag because Tesla and Amazon have been lagging. Nike's been terrible. So there's some, Starbucks has been terrible. So there's some top 10 names within XLY that have been keeping this guy down. But again, there's some small and mid cap stocks in consumer discretionary that are doing extremely well. Shark Ninja's one. I was just on CNBC yesterday. I'll show you that stock. We have that position on Shark Ninja, a little consumer retailer, cleaning products, cooking, household products, companies crushing earnings, and stocks breaking out in XLY. Okay, so yeah, there's an attempted rotation into defensive, which is utilities, staples, and to some extent healthcare. And then there's going to be some cyclical influence in financials, industrials, some consumer discretionary that we're seeing here on the weekly. But we haven't really gotten a full rotation over here. We're a long way away from seeing a full cyclical and defensive rotation in and an offensive rotation out, namely tech and comms and some consumer discretionary, right? The monthly and the weekly are very different. We're really trying to do it. But if we start to see a rotation over and everything other than tech and comms, these monthlies aren't going to make it. And it was just a 6 to 8 week short-term move ahead of the first rate cut. It could develop into something more, but the way the AI trade is going, I don't think so. I think people are just getting nervous, and we can talk about Nvidia and the comps. I think I probably beat this one to death, but I just want to share with you the sector allocations that I have for the wealth management portfolios based on everything I just said. So this is the last rebalance I did for our income model. This has roughly 55 individual equity names in here, and I select names within the portfolio based on technical fundamental characteristics, but I try to fit the holdings I have for technology, consumer discretionary, and comms based on my allocation, my pre-allocations that I set up based on where I want to be, where we are in the business cycle, where we are in the rotations. So this is, I'm about to rebalance SIG, which is strategic income and growth. So this will change here coming up, but this is on the last rebalance. And you can see the adjustments that we've made, prior allocation, and then relative to the S&P, right? So I've been underweight healthcare. I've been overweight by 2% real estate, underweight financials, comms, a little underweight consumer discretionary, and overweight technology by 2.5%. This is going to change, okay? I did just adjust and update a lot of positions in TAG, Tactical Alpha Growth. This is our growth-oriented portfolio. So we have 30%, 37% allocation to tech. The S&P is 32.29. So I'm overweight tech 4.71%. I'm overweight consumer discretionary, overweight comms, slightly underweight financials, slightly overweight industrials, a little underweight staples, overweight materials, underweight utilities, real estate, energy, and healthcare. And again, this is the growth portfolio, right? It's not the more stable income producing. So I just wanted to show you that on a holistic thing. Okay, we already talked about this. Yield curve is coming out of inversion. We know that. The real yield curve, so when we look at inflation expectations, the 10-2 guy has come out of inversion, which is good. So let's get into some technicals here a little bit. So, the wave counts on the S&P are challenging. I think the late 2022 and 23, it from an elite wave point of view, it's kind of driven everyone crazy. And there's a lot of dissenting opinions out there as to what this can be. And I certainly get it. So don't really know what's happening back here in 22 and 23 yet. I'm trying to focus on a couple things. The shape of the pattern that we go into here in the S&P and NASDAQ. What do we do with the late 21, early 22 breakout highs in the indexes? Okay. Wondering if we start to head into some triangles. Okay. And I'm going to show you Nvidia. I'm going to show you the NASDAQ, but I'm wondering if we start to head into sideways triangles as we get into through seasonally weak and volatile September into October and then into the election. Okay. We'll come back to the Nvidia fundamentals. All right. NASDAQ and S&P market's just chopping around, absolutely chopping around. Okay, so longer term, here's what I'm thinking on the NASDAQ 100. It's a weird count. It's a very dicey count. Okay, the indexes have been incredibly difficult to count on an 8-wave basis. We're above the 21 highs. We did come back to retest it. We didn't get a full retest. We moved up here into July, sold off in August, bounced back in August. Here we're in September, the first week, selling off again. I'm wondering if this is some kind of consolidation that would be wave 4 that would square up against wave 2 back at the end of 23. I seriously have my doubts on this count. One, it's ugly. 2, wave 3 is shorter than 1, which is not wrong, just not common. It's a 618 3v1 projection. So, all right. You know, and if that's the case, I don't want to put wave 3 up here because that's going to leave this as a big 3-wave move. And you never have your 5-wave, your 5-wave move. Okay, good motive impulse. You never, a lot of people make this mistake with Elliott wave. You never want to have your 3rd wave be anything other than a good 5-wave push like this. See, green 3 needs to break down into 5 waves. If I were to take this green 3 and put it here, it would be up, down, up. So that doesn't really work. That's a 3-wave move. So I'm wondering if we might be going into a triangle here in the NASDAQ. It's really ugly, but it looks better than Nvidia. I'm going to show you that. The thing with this, and I just described with the members this morning, we would need to get below this March high of 18,464 in the NASDAQ 100 because the E wave of a triangle needs to retrace at least some of the prior 3rd wave. We need to get below this by a little bit and then not break below 17,455. So I don't know if this is going to work. I'm not hanging my hat on this count. I think it's pretty ugly, but the reason I'm entertaining it is Nvidia has a very nice possible triangle count. Okay, this is going back to late 22. So we have 5 up in 1, nice push back in 2, move up in 3. So now this guy, this possible wave 3 is complete. Maybe we're going into a wave 4, a green 4 that's going to square up against wave 2 from 2023. We had a push down in August. We had a move up to a lower high at the end of August. We just sold off again, and we seem to be holding the low. So as I get off the weekly down to a daily, we had a lower high here. We may be putting in a higher low here. And once you start entertaining the idea of the end of wave 3, well, wave 4 is where you are. And might it be a triangle? And it could be. I don't know. I can't know. But what I do know is the should hold zone is 100. The must hold zone is 90.69. We're trading 108. We have risk down to 90. It's a big percent move. If I put wave count and validation here, 90.72, this is the risk we'd have to take because we should not break below there. 17% roughly from current. Well, if you have, call it 16.5%, 17% of risk, can you see yourself making 34% on the upside to justify the 17% risk you had to take on the downside? I have resistance in Nvidia into that highlighted zone which from current levels is 100% from here. So this is what I'm talking about, where you don't need to know the future. You need to thoroughly assess the now and say, okay, I'm risking 17% to make 100%. If I've got the stones to stick with it and forget the noise that comes, the inevitable noise that will come along the way. Right. And you do have to have an idea as to what's going on in the macro, what's going on with the AI trade, with the build out, with Nvidia's earnings. And, that starts to give you confidence as to what's happening. I wish I had the indexes behind us, and I don't, because it's a choppy mess. And I'm treating it like a market of stocks, not a stock market. The S&P is, I don't know what's going on with the S&P. You think the sky's falling, and we're 3% from all-time highs. We're 2.62% from all-time highs in the S&P, and you'd think we're going into recession. The wave count is so nasty. So what do we have in the S&P? S&P is blowing back to the 50-day. It might be wave 4. I'm really not hanging my hat on this. I'm wondering if we might fall into another triangle consolidation, chop it up through October as we get closer to the election. That kind of makes the most sense to me. Okay. And then, we know where we looked at on, we know what we looked at on the wave count in Nvidia. I think it's important to keep in mind, what this company is doing. We just reported earnings right here, August 28th. We beat EPS, we beat revenues. And what's happening, I think, with Nvidia is we're now comping against this quarter, which is the first one that, as we enter the hyperbolic growth stage of Nvidia, we're now comparing against this first quarter here, because it was this one to this one where Nvidia, it was a whatever report, but they said, Wall Street, you're off by half as to how much we're going to make next quarter. They reported 7.1 billion here for this quarter, for Q2. And they said, guys, you're off by 50% for next quarter. We're going to be at like 10 or 11 billion, I think. And then they came in at 13 billion. That's what got this thing going. So the way that you look at earnings, you're like, okay, you want to look at the quarter in the year prior. So now we're only growing 111% and 105, 120% EPS and revenue growth year over year, where they're used to seeing 400%, 496, 593, 429% growth, because you were comping against Nvidia before we went into the hypergrowth stage. So the fact that it beat EPS and revenues, beat them well, good guidance going forward, but we only beat by 100% compared to the prior quarter. The shock and awe is gone, because now we're comparing against Nvidia in the hypergrowth stage. That's what I think is going on there. Part of it, not all of it, but part of it. Okay. So that's the end of that report. I'll show you. I told you I would show you Shark Ninja, which is kind of a funny name. Let me bring this guy over. You guys are quiet. Everyone good? I get nervous when you guys aren't yelling at me. Let me just do this spin through before I get into Shark Ninja. Nice, Joe. Okay. So yeah, we're seeing a move out of tech, and we already talked about that. Sectors. Okay. Here's tech, and we're going to go on the weekly. XLK. We had a move to all-time highs in July, sold off in August, coming back. Now we're starting to go sideways here a little bit. Okay, now we're starting to go sideways. Maybe we're going into a triangle. Could it be a head and shoulders pattern? Maybe. And I could be wrong, but I think below 190, then we're going to start to get a better idea in XLK. But the point is, yeah, July 8th was the high in XLK. XLC communications ETF. We bumped up against the highs. We did a little double top, backing off a little bit, comms at highs. Consumer discretionary is not at highs. We are well off the December of 21, November 21 highs. But again, we have some big stocks in consumer discretionary that have been lagging that I think a lot of casual market observers say, well, look at XLY. It's not at highs. We have recession. No, Tesla's a huge component of this. I'm not even sure Elon wants to be in the car business. Tesla's been in a sideways mess, so that's keeping XLY down. Nike's in a total mess. I think they've kind of lost their way. They're starting to come up off the lows, but we were at 180, now we're at 80. Stocks got destroyed. It might be so bad it's starting to get good. We'll see. Give me on cloud all day long in consumer discretionary. Give me Skechers, give me Deck, DCK, give me Crocs, not Nike. So consumer discretionary and Shark Ninja is consumer discretionary. I'll come back to it. This thing is ripping topside. We just got the break out of this. We're coming up in a channel resistance, and I'm very aware of it. Look at, you say CMG's had problems. CMG's a large cap consumer discretionary, and this guy's come off. No, they just lost their CEO to Starbucks, and consumer tastes and preferences are changing. So you can't say, oh, we're in recession. CMG's off the highs. Give me Kava. That just crushed earnings. Give me Kava at highs. Give me Sweet Green. That's at highs. So look at home builders at highs. There's plenty of examples of consumer discretionary stocks that are absolutely ripping. So I think consumer discretionary is suffering from the large caps who have not idiosyncratic, but company specific issues. Starbucks, we know the issues they've had. Lulu had a valuation problem. Lulu was way too expensive for a long period of time and came off quite heavily and is now starting to stabilize. So that's XLY. So be careful when people say, oh, XLY is not at highs, we're going to recession. That's a nuanced conversation. And more to that, financials, new highs. Industrials, new highs. Materials, almost at new highs. Almost at new highs. Energy's a mess. I'm going to skip that. Real estate is not at new highs, but real estate has made a very nice move up. This 45 level in XLRE is going to be really important to see if we fail. Staples, new highs. Staples at new highs. Oh, it's defensive. We're going to recession. Look at Costco. Costco's ripping on the top side. Walmart is ripping on the top side. Like, I don't see it. Like, we're going to a recession. A Ferrari just broke to new highs. How does that work? Utilities, yeah, it's a counter rates play with the Fed cutting, but it's also power demand on the AI story. Utilities almost breaking to new highs. Healthcare, new highs. So I'm not quite buying it. A few stocks I'm showing your active ops desk. These are positions that we have on right now. Uber, back into technology. Uber, I think, looks pretty good above the 75 mark. Looks amazing. Southern Company, I already showed you that one. Sales is getting wrecked today. I don't love that. Yeah. Shark Ninja up 2.74%. Kava, I showed you that one. Meta, you talk about the communications. Meta looks awesome. I think we're in a triangle in Meta. Communications, everybody except Google and comms looks really good. So here's a weekly of Meta. Weekly, put in the triangle, get off the weekly down to the daily. We have a completed 5-wave swing. ABCDE should be popping up. I love Meta on the top side, and looks like we're just pulled back to the 50-day moving average on Meta, and we're getting a little bit of a bid. That one's actually interesting right there. Spotify, I'm just waiting for the time. I don't want to say when. I would almost say when. I would say if this guy breaks out, there's going to be a pretty quick ride up to the all-time highs at 386. If I'm wrong, I'm wrong, but Spotify is just waiting to break top side. And then also in communications, look at Netflix. Netflix is right at the highs. Netflix made highs, I think. Netflix is right at all-time highs. T-Mobile within communications. T-Mobile making new highs, all within comms. Comms looking good. Okay. All right. And those are some of the hot watch. So what do you guys think? Everyone good? Everyone good? I'm going to leave it there, but I think we hit a lot in a short period of time. And I would recommend, if you'd like more of this every day in specific portfolios, come on over to tradinganalysis.com on the research business. And if you are interested in the wealth management, InsideEdgeCapital.com. Okay. All right, guys. I think we're going to leave it there. Thanks for joining us, and I will see you guys on the next update. All right. Best of luck out there. Hope you're okay in September. We'll have to see you in October. All right. Take care, guys. See you.